Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to share with you a snippet of a webinar that I did yesterday to our internal group of about 150 people. And what I talked about is about trading up, and how if you've bought commercial property in the last 2, 3, or 4 years, this might be a great time to actually trade up the property rather than refinance the property. And the reason we talk about that is that sometimes you have to go from a starter property to the next level property, so you actually end up with more capital gains in the future, more security, and really be on the road to create generational wealth. So let me show you on the whiteboard and show you the snippet in my webinar of how that works, and I'll see you after.
All right. Okay. So I want you to imagine two scenarios. Okay. So we're going to dissect this into two scenarios. So one is a metro property and one is a regional property. And these are two real scenarios. So metro property is a property that was bought 2 years ago, roughly 2 years, 2 and a bit years ago. It was bought for $2 million and it's on the Gold Coast. So we've just had a valuation. So this actually settled in early 2020. So maybe 2.5 years now when you look at it. Yes. And now it's just had a revaluation. In fact, it's one of the properties that Greg manages for our client. And the valuation came in at 2.7 million.
2.71 actually.
2.7 million, round numbers. 2.7 million. So if you look at this, that's really about a 35% increase in capital growth in 2020, from 2020 to now, right? So over the 2.5 year period, potentially, 3 years, depending on how long you've held it for. Now, he has a number of options. He could refinance the property. And by the way, can you guys all see my board properly? Yes?
Yes, I think so. Anyone?
Okay.
Can anybody not see?
Or sell the property, right?
Okay, we've got lots of yeses.
Okay, so we have a couple of options when they're either refinance or they're going to sell, right? If you're going to refinance, and I need to walk over there and grab a paper to wipe down stuff. So I've walked off. So if you're going to refinance, and let's say this was a lease stock loan. So we're working on lease stock loan, right? It's a 65% LVR lease stock loan. And what happens when you refinance? Let's say they bought it also at 65% LVR. So for the purpose of this, we're going to do lease stock loans. Loans, right? So what that is based on the lease itself and not on your own servicing. So it's 65 LVR standard. At the moment, certain property can go up to 70, but we're just going to work 65% across the board. Now, at 65% LVR, they're borrowing at the time 1.3 mil is the borrowing price. So you would have put in about 700K plus costs. Right, so that would have been how much you would have put in, right? So now 1.3 at 2.7 million, 65% 2.3 million is how much, Greg? You can be my calculator.
2.3 million?
2.7. Are we recording? 1.755. Oh, we're recording, right? Yes?
Yes.
Recording.
Yes, of course we're recording.
All right, I'm just checking. Sometimes it does. So 1.755. Now, if you were refinancing, you're only going to be pulling out 455,000, right? Which really is going to get you probably about a $1.1 million property right now in this current market, which if you've gone out there and had a look out there, you're not going to get a huge amount with a huge yield. You're not getting that same buying power as you did 3 or 4 years ago, or even 2 years ago, right? Because the market has boomed and we're in a heated market. Now, but what if he's sold? So let's say he's sold for 2.7 million, right? So then our equation becomes that 2.7 million minus the 1.3 mil in loan minus the 700K in deposit minus, let's call it, you know, the 5% in costs, which is about 40K. But also minus, on top of that, his miscellaneous cost of setting up the entity, anything else he did on that property. So let's call it miscellaneously on that, just a 20K miscellaneous, plus, you know, his minus commissions from the agent, right? Or something like that. 2% of something, 2.2. So let's call it 50K from agents, right? How much are we left, Greg?
Sorry, I'm just checking here. 27.
27, a minus 2 mil,
Yeah.
minus 110K.
590.
590K, right? So that's your profit that is going to go to your capital gains, right? So now, what happens with capital gains is you get a 50% CGT discount because you've held it for more than 12 months. And if you're holding it in, not a company, but in a discretionary trust, corporate trustee, or you're holding it even in your personal name, right? But, you know, you get the 50%, right? If you're in a company, you just pay straight 30% of there, which is a little bit more. If you get the 50%, then basically you're halving that figure. You're halving that figure. So let's halve that, saying, you know, if we halve that figure,
About
we've
295, 300.
so we've got 295 to keep, plus 295 where you have to pay, let's say, the highest tax bracket, which is roughly about 45%, right? So that needs minus 45%. So how much is 45% of 295K?
133. 33.
133K is tax. So how much do you have left?
162.
162K, right? So you've got that. How much is that left? So you add the 162 here. How much do you have? 162 plus 295.
So you're about 460,000.
Yep.
457, call it 460 for easy maths.
Yep. So 457. You add in your original deposit. So add previous deposit. Just call it deposit. Deposit of 700K. You have 1.157.
What? Correct.
7 million, right? That's how much you have in a deposit. So this is your new deposit. Okay, so this is your new deposit. Now what happens, a new deposit at 65% of 65%.
New deposit 65%.
Percent LVR equals purchase price of roughly about 3 mil.
Hold on, let me 16.
Divided by depending if you're going to get
3.3 mil.
Yep, 3 to 3.3 mil is where you're going to get 65% LVR, right? If that's, you know, if you include costs, if you're putting in more costs or more, if you've got more savings, then you're at 3.3 mil. So that's your new purchase, your new price point. So by selling this property, you've gone to, if you didn't sell this property, you would only refinance and buy something at 1.1 right now, right? But where you sell this property right now, you can, because you've actually gone metro, what you would do now is actually go regional, right? And so what happens here is at regional, you can still get 7% plus. Not plus, but plus, you know, 7, maybe to 7.5% in a large regional town because you're at that price bracket, right? Because you're in this price bracket. If you're at 1 mil, you're not going to get that. At 1 mil, you're at 6 to 6.5 or 6.5%, depending on what you're looking at. But at this price point, you can get around 7 or above 7, right, in the regional areas. And that means you're actually going to sit above market. You've actually gone above where the typical investor will be, and you're actually going to get a solid chunk of property, right? So you're going to get freestanding. You might be able to get multi-tenant.
A blue chip tenant?
Maybe, maybe not. Large regional town. So you've got some security. And what happens here is that gives you that cash flow. That gives you additional cash flow. If you bought using that and you bought something at 1.1 and you bought it in regional, you're competing with everyone else, so you're going to have a lower return. If you bought in metro, the yields are going to be 5.5%. So you're not going to get a huge chunk. Whereas buying in regional, you've now turned your property, which you've already picked up the capital growth, you've gone to regional, and you have now is you've got a solid property. And this property is probably going to be a strata. You bought this as a strata, so this property was bought as a strata property. You've now become now you've got a freestanding property, regional, large enough footprint and secure enough, right? So this is where you end up with, and how much cash flow do you get on 3 mil at 7%? 70,000 times 210,000. 210K net, right? That's before mortgage. Right, so net rent at 7%.
Still 20 grand a month. Does that not sound too bad?
But there's some borrowings on it. Like you borrow 65%. 65% of 3 mil.
1.95 at what interest rate?
Let's go 3.5.
68,250. Well, call it 200 grand net.
No, 210. You get 210. 3 sevens.
68,250 from.
Okay, 70,000 from 210. 210.
110 minus.
70. 68,000.
Still netting you 140,000.
Yep, 140,000.
140.
I couldn't see the number you were.
Sorry.
Yeah.
Yeah. So 140 passive. Right?
Right.
So that's the outcome you end up with.
12 grand a month. Is that not bad?
12 grand a month. 12 grand a month. Right? When you originally bought this, you would have bought it at a higher yield, but because the rate has gone up, and now what you're looking at here, you're not going to get this. This is actually a better cash flow position for future growth because you've got freestanding. And freestanding means that you could later on add more value to the property, increase the rent faster and in regional areas, and have that solid property that continues to grow in value, right? So that's why we would put that scenario forward if you are trading up, right? So you've gone from a 2 mil property, you've gone into a 3 to 3.3 mil property without you having to add more cash, right? Obviously, if in this time, all the cash flow here, you've managed to accumulate another 200 grand, another 300 grand in the years that you've had it, or 200 with your own savings, you can go from a 3 mil to a 4 mil property. Obviously, that changes the equation again, right? And you've added probably another 40K to this, you're 160K, right? So here, what we had was, let's work out the scenario here. What is the rate on the 2.7 mil? I think it's at 6%. I'm pretty sure it's worked on 6%. Yeah.
Correct.
So what's 6%?
So it's 162,000.
162,000. So currently, that's 162K. Is where it's at. If you did refinance it, you would be pulling out 1.775 at 3.5%. 1.755 at 3.5%.
Is 62,000.
62K. So that's about 100K. 100K there. Now, if you use that property and you go regional, a lot of times you'll find you can't buy freestanding in regional, right? And you won't be able to get 7%. So what a lot of people, when they've done the comparisons from what we've seen, is that they're not excited by the properties they can get at regional at that price point. So they've often come back to metro and said, hey, I want to go to stay in metro, and we're going to settle for that 5.5% at most, right? So if we settle that at 5.5%, and let's say what's the one, 455? 455,000 divided by 65.
700,000.
Oh no, sorry, divided by 0.4. Sorry, 0.4.
450 divided by 0.4.
Yeah.
1.1.
1.1.
1.1. Okay, so you say 1.1 mil, and how much would the loan be on 65% of 1.1?
730.
730, 3.5% of 130.
Veland's suggesting we need more whiteboard. It's probably
Yes, we do.
So
3.5% of 730.
730 times 3.5%.
Yep.
true. 25,590.
Yeah, 26 grand.
26 grand. Okay, let's call this 26 grand because I'm running out of whiteboard. Okay, so 1.1 thing, you're probably getting 5,000. So you're probably getting 60k. Yeah, you take away that, and you've got about 60,000. Take away 26,000. 34. 4k. Right. So you're 134k. Right. And you're 134k if you did this scenario, right? So you've leveraged, you've got 100% to the other one, you're 134k. Now here you might be 140k, right? You're thinking, okay, well, I'm only 6k difference, right? That doesn't make a huge amount of difference, right? But the thing is, what you're buying property is that you're not purely yield driven, you're actually looking at going, what's the next step, right? Because what you want to do is make the 3 mil a stepping stone to buying a 5 mil property, right? So in order for you to get to the 5 mil property, having 2 properties like this is going to serve you less than having a growth and being able to tweak a property and actually build on a property like this where you get a solid footprint, right? And properties like this will trend downwards because there is very few of these solid properties that are maybe your retail strip malls. This might be a whole freestanding building. This might be a couple of warehouses. Now that in time, people are going to be searching for that value, right? Because value never dies, right? And as the value proposition happens, you will actually get more yield compression in this area. And therefore, you'll get that jump, that capital growth, the same capital growth. What we're not going to see is that same 35% happen in that metro area because we've just had that jump, right? So that's why that scenario in the future will allow you to actually buy back into metro. Because what happens is at 3 mil, even if right now you go to Sydney, Melbourne at 3 mil, you're still buying a strata property. You're not buying freestanding. And if you're buying freestanding, the yield is 3%. I've had a client today who's selling a property in Bankstown, and she's basically have kept it for 20 years and it's going to be sold for 3 mil and the rent on it is 100 grand net. Right, so it's a 3%. Right, so if you have 3, and that's freestanding, if you're going right now, you're buying a freestanding 3 mil, there's no point for you to go and trade up to a freestanding in Sydney right now because the value, if you go to 5 or 6, yeah, you're going to have that yield, you're going to have freestanding, it's going to be different, right? What you want to do is from here, go to here, and then come back to your metro areas and be able to buy a $5 million property, the next chunk, right? That's where you want to go. And that's the scenario if you have properties in metro. And this is a real property. This is a property that Greg manages on the Gold Coast in Surfers Paradise. 2 million is a strata office space. In time, it's had a revaluation of 2.7. It's gone to, the client prefers to refinance with another one of his other properties so that he can go bigger. But if he was to sell, then this will be the scenario going through. I know this might sound a little bit complicated, but ultimately, by trading up, you actually prepare yourself for better growth and better value in the future. Does that make sense? Hopefully.
Yep.
Hopefully. Now, I'm going to share with you another property. Let's say you are in regional. Now, let's say in 2020, when you bought in regional, most of the time, most people when they're buying regional, they're not going to spend 2 million in regional. In 2020, most of our clients bought $1 million properties in regional. 800 to 1.2, 1.5, and that's a freestanding property. So they bought a freestanding property. So that's freestanding. Right. and they bought a freestanding property right now in Metro, and they probably bought that somewhere around 8.5% yield. Some of them higher, and this is before pre-2020. So let's say 2020, even at 2020 we're getting that. Pre-2020 you probably were getting 9, but let's say 2020 you're getting 8.5%, right? So over time, right now, the yield in that market has compressed. So Townsville has gone to 6.5% yield. Yeah. Right? 6.5% yield. And what it has done is that what that means is that a property that's at 1 mil has now gone up, but that's saved to about 1.3 or so. So let's look at that. Let's say that, you know, they bought it and the rent was at the time in 2020 85,000, right? A net rent, that's the net yield, right? Over time you had roughly a CPI increase, which is roughly about 2 to 3% over, say, let's say to now, 2.5 years. So the property is probably somewhere around 88,000, right?
Correct. It's worth
85 times 1.03.
1.35.
1.35. So at 6.5%, it's 1.35 mil, right? You see, same growth, roughly same growth, is because they've had a boom. If it wasn't for COVID, regional wouldn't have had this boom. It would have given you lots of cash flow, but not the growth. But it has now given you growth. So now you're thinking, now I have 2 options. I refinance or I sell, right? The same 2 options that we have here. So if we refinance, and we originally did this, remember this is a lease stock loan, so 65% LVR is what we're doing. So refinance, how much do we have, how much can we borrow? 65% and 1.35.
877,500.
500. And previously you had 650K you borrowed because 65% LVR.
227.
So 227, 2 what?
227.
227, so 227. So you had, so that's the old loan, 227,500, right? If you take 227,500 at 65% LVR, how much would you buy? What's the property price?
Now, isn't that divided by 0.4?
Yeah,
570.
570. Which, if you look around, there's actually not a lot of stock at 570, right? Not a lot of stock at 570. And most of the time, you probably, you're kind of stuck somewhere. Like, you kind of go, well, what do I do with that, right? What do I do with that? Unless you top it up. If you top it up by another 200K or 100K, then you can go somewhere. So that's fine, right? So that's one option, right? And then the second option is you sell. You sell because the yield has compressed to a point where that is very close to something you could get in Metro, right? You get something in Metro is that you sell. So you sell at 1.35. 0.35 mil. You take out your 650 loan. You minus your 350 deposit. You minus your costs of 20K. You minus miscellaneous 10K. Commissions of 20K. We got deposit, costs, loan, miscellaneous, and commission. Great. All right, so let's make it 25 because there we're just using comparables, right?
Do you want us to calculate that?
Yes.
Well, I can't see that far because you're between me and the board, so let's do the maths.
All right. 1.35 million minus 650.
Slow down. 1,350,000.
Minus 650. Yes. Minus
700.
yeah, minus 350,000 minus 20K, 10K, and 25K.
That's 295.
Yep.
Is what?
295.
295K. Right. Now, remember we were going, that's your capital gains tax, right? And that's 50% discount. Yeah. So what that happens is that there is 295 divided by 2.
Sorry, say that again.
295.
147.
147. Okay. So then you pay 40% of 147.
Just 59.
59. Okay. 59k in
Which equals
tax.
88 grand.
88 grand. So you got 88k. You add 88k to your 147.
235.
235k plus what you put in before, 350.
585.
585k. 585k. Now that at a lease stock loan, 40 divided by 0.4. 1.46 mil. 1.46 mil?
Yes.
Okay, 1.46 mil. Okay. So that's what you can do with lease stock.
Well,
Right.
we'll just cover capital gains tax.
So 1.46 mil. What I would do here is that I would buy this. I would buy a property in Melbourne, a strata property. So we're changing freehold to strata. So we're flipping this the other way around at a 6% yield, an office space. Right? It's because capital growth from pre-COVID for office spaces were at 4%. So if you go into strata now, you've de-risked your portfolio here at 1 mil, where in regional now you're at the lowest end, and where also that's very, very popular to sell that property. So you could sell that property for 1.3 or even more. And you've got to the 6%. And what that means that in the next few years, as that compresses to 4, 4.5 or 5, you've now got a chunk. You've actually de-risked your portfolio from the 1 mil, and you've gone up a bracket. You've moved up by almost half a mil, and you've bought in back into Metro, and you've bought at 1.6, at 1.5 in Metro, and you're buying office space. You're buying a substantial office space. Again, you're not buying the startup office space. You're getting, half a floor, sometimes a whole floor. You're getting substantial property at 6% yield, because most people are not wanting to spend that in this current market because they're worried about risk. But again, without risk, there is no reward. You wait for that to compress. So you wait for the yield to drop, so yield to go down. So the value of your property goes up. And when it goes up, you go, and now you can go and buy a larger property in Metro, in regional.
Well, at 4%, you're at 2.2 there.
Yeah, so you can go back there. So if it goes to 4%,
Which is 2.2.
you're at 2.2 mil. If it's at 5%, you're at 1.8 something, I think. You're 1.8 or something like that. So so that will help you then to, recycle that, go and buy something substantial, go back into regional areas so that you buy the larger assets, right? It's always about buying the larger asset, right? And with that, you'll get cash flow. The cash flow will probably be comparative to if you refinanced. Like the cash flow will be similar, but the growth will be so much more different. And that's why you will implement this strategy, because at 1 mil, at 1.35, because there's really nowhere to go in this current market. At 570, there is some stock, but you do have to wait for that stock. The yield's not going to be flash because people are literally buying this with cash. And so what you want to do is you want to be able to trade up so that you can continue your journey and continue buying up and up and up. So about going the next step up and the next step up. It's a journey, right? It's a journey. So if you own this for 2 or 3 years, you might have this for 2 or 3 years, you might then go to another property, because ultimately when you do retire, you want to retire on not this one, and then, another 500,000. Okay, I'm going to do another 500,000 or another mil. So when you retire, you've kind of got 10 properties. They're all 500 or mil. Then you're sort of trying to juggle. What you want to do is come to a point where you go, okay, I've got 3 or 4. They're between 2 to 4 mil properties. They're really, really good, solid properties. Each of them produce solid income, solid quality of tenants, solid properties, whether they're strata in a key location or whether they're freestanding, good properties with good quality tenants in regional areas. That's what you want to do. Right, and that's where you ultimately build that retirement nest egg for you, so that you could go, okay, even if it's a willable asset, you're passing on something that is going to sustain time, right? And that value, true value, continues to hold. Especially in a market where it's hot and we're seeing compressed yield, value will always outlast.
So you've now seen how trading up can really help you move forward to create some solidarity in your portfolio. What you want to end up when you actually have a group of properties is properties that are going to be versatile, that give you diversification, and that in the long term it creates longevity and continues to hold its value, that it is a willable asset, and that you're creating generational wealth, and you're really building that tree that's going to produce fruit that for you in retirement, it's going to provide for you in passive income, but also for your children and your grandchildren. So that's why trading up, especially in a market where it's hot and people are below like a certain level, sub 1 mil, sub 1.5 million, where it's really, really hot, but by going up a level or joining a group deal where we're accessing $4-7 million properties and getting a good yield where others can't is really going to give you an advantage. And once you go up there to that level and you get to that level, you are going to sustain that advantage continuously moving forward. Again, whether you should trade up, you should sell, you should repurpose that money, you should be refinancing, it's a conversation that we need to have. It's a calculation we need to run. We compare one to the other and what you can get in the market. So reach out to me, helentarrant.com or helen@commercialpropertycashflow.com.au, and let's jump on a call. Let me help you work out what your next step needs to be. But in the meantime, press the bell, subscribe, and I'll see you in the next video. Bye for now.